Welcome, everyone. I'm Margie Graff, President and CEO of the Rockville Chamber of Commerce, and welcome to our educational series today. We're very proud to have one of our sponsors, Aaron Boker, he's a partner in Aronson, LLC Tax Service Group. Aaron is a proactive advocate for his clients, which includes restaurants, hotels, food distributors, retail businesses, breweries, real estate owners, professional service providers, startup business owners, and high net worth individuals. Aaron provides tax compliance, tax planning, and other business advisory services to his clients. With 13 years of professional experience, Aaron's clients have benefited from his dedication to excellent service and commitment to being part of Aronson's results-driven tax team that's committed to staying at the forefront of the profession. So thank you, Aaron, for hosting our Employee Retention Tax Credit seminar. I also want to thank Steve from SHS Services, who's also a sponsor of our seminar series. So thank you. And I will turn it over to you, Aaron.
No, thank you, Margie, for the introduction. Very well said. Good afternoon, everybody. I'm Aaron Boker. I'm a partner with Aronson LLC. And really what I wanted to take a little bit of time this afternoon is to talk about a credit that really kind of interplays a lot with the PPP loan. You know, we've had a lot of webinars and a lot of discussions on the PPP loan, and really what the objective has been for a lot of business owners over the past years. What can we do to get you help? What can you do to get money into your business during a very difficult time? And you know, our firm has been studying this credit for the last couple of months, and we feel that there could be some opportunities with this credit for business owners. Don, would you mind sharing my slide deck, please? Okay. Fantastic, thank you. All right, so let's go to the next slide, please. So let's go over the highlights of how this thing works. So the Employee Retention Tax Credit, and I may refer to it as ERTC. You know, there's been acronyms out there for ERC. I like to use ERTC because it's tax credit. I like tax credits. That's what I do. But this ERTC was originally put in place during the CARES Act, which is the same bill that gave life to the PPP loan, which came out back in late March. And it worked very similar to the PPP. Same rationale was the point was to try and reward employers for keeping people on payroll during COVID. And this is a refundable payroll tax credit. It's claimed on the quarterly, employment tax returns, Form 9041, and it's directly correlated with the wages and the health insurance plan expenses you pay on behalf of your employees. Now, while this thing came out in late March, but what we found early on was if you got PPP, you were automatically disqualified from ERTC. The rule of thumb was originally it was one or the other. So with everybody going after PPP, which in all honesty of the two was the one to get, but the problem, so this was effectively a non-starter for almost 100% of our client base. But then in December, there was another stimulus package that came about, and they came out and said, you're allowed to have this package along with PPP. So you can have PPP and ERTC. And what this also did was ERTC not only was cleaned up for 2020, but it was also extended into the first 2 quarters of 2021. Kind of similar to what PPP was done as well. Next slide, please. So who qualifies? It's any business owner or any nonprofit organization that experienced one of the 2 following items: a full or partial suspension of operations. I'm going to talk about what that means in a second. That's, it's a very, there's a couple things we got to go through with that. Or 2, and this is more measurable, a significant decline in gross receipts. So now we're going to talk about what does a full or partial suspension of operations mean. Next slide, please. So in order to have a full or partial suspension of operations, you've got to be ordered by the government. It's got to be a direct order that says you've got to either suspend your operations 100% or you've got to partially close it. And the full or partial suspension of operations must, and this is key, must have a nominal effect on gross revenue. So the government's got to come in, step in, and it's got to do damage on your revenue. So what I thought we would do is we kind of go through a couple examples of whether you have a full or partial suspension of operations. The first one is generally pretty straightforward: restaurants. So restaurants, there's mandates on whether or not you can have indoor dining or you can't. And even when indoor dining was allowed, there's restriction on the capacity. The restaurants are required to have the tables at least 6 feet apart. So that right there is a government mandate, and it clearly has an effect on the restaurant's gross revenue. So they would meet that criteria. Another example is, let's take a grocery store like a Safeway or a Giant. Now that's considered an essential business, and they've been allowed to stay open from the very beginning. But a lot of these, Safeways or Giants, they have little buffets. They sometimes have coffee cafes, within their stores, and those they had to shut down. And while that is technically a partial suspension of operations, but the question is, did that really have a nominal effect on revenue? And generally speaking, that's usually a small sliver of a Safeway or a Giant's revenue. So the answer is they would not meet that criteria. Partial suspension of operations, but not a nominal effect on gross revenue. Law firms are a little tricky. So law firms, a lot of them got hit early on in the pandemic because the courthouses were closed, litigation and transactions was put on hold. And so while the courthouses and the litigation might have froze up, the law firms were open for business, from the very beginning. So they technically do not have a full or partial suspension of operations. It was just the people they were doing business with had an issue. Medical practices, that's kind of a dicey one. Medical practices, again, another essential business. They were open from the very beginning, but there could be some special circumstances. I'm going to use, my kid's pediatrician as an example. So a lot of these pediatricians' office, I've been in there a few times with my kids, and it's a zoo when you go in the lobby. There's a lot of kids in there, a lot of parents, and if the government comes in and says, hey, you only can have X amount of people in the waiting room, and if the government steps in and mandates the limit on the people that are allowed in the waiting room, that could impact the amount of appointments that the pediatrician's office is allowed to have at any given time. So that right there, you could argue that there's a partial suspension of operations because there's a limit on the amount of people you can have in the building or in the lobby at any given point. And if it has a nominal effect on the revenue, you pass that test. Gyms, perfect example of this. A lot of gyms were forced to close, or they're open right now at very limited capacity, so they would meet this criteria. I have a client that's got a sound production company. They actually would not pass this criteria, while their revenue might have been down, but I have a client that's a sound production company, and they've been open from the very beginning, but it's just, I haven't been able to do business because the Merriweathers, the Jiffy Lubes, the National Harbors, those places have been closed. So it's them that had the full or partial suspension of operations, not our client directly. So therefore, they would not meet this test. And then I'll throw in one example, Aronson LLC. Back in March when this all started, we were all forced to go home. And for the most part, we've still been working from home from the beginning. And while we could argue that we did have a partial suspension of operations where we weren't allowed to be in our office, we all got sent home, minus a handful of people that stayed behind to check the mail, scan in documents, deposit checks, but we were still able to do our jobs remotely. So it really did not really impact our trade or business. So therefore, we would not pass this test. So that's really a very important thing. So you really got to look at the facts and circumstances if you're going to claim full or partial suspension of operations. Next slide, please. So the way we tackle this credit, there's two different sets of credits. There's ERTC version 2020, and then there's ERTC version 2021. So we'll tackle 2020 first. So 2020, in order to claim the credit, as we mentioned, you got to have one or two tests meet. You've either got to have operations full or partially suspended, or you got to experience the decline in gross revenue. And this decline, you've got to demonstrate that you've seen a drop off in your gross revenue by at least 50% in any quarter of 2020 compared to that same quarter in 2019. But then, you get to keep claiming ERTC once you have that first credit, but it stops the moment when you get your revenue back to 80% of 2019's levels. So to give you a quick example, let's assume that a business was status quo January of last year through the middle of March. So everything was okay until the pandemic hit. And then when the pandemic went down, the revenue took a nosedive. Most likely first quarter would not qualify because it's probably gonna be very hard to have a 50% drop off in first quarter, assuming the first 2.5 months were okay. What we're finding is second quarter is generally the bad quarter. So assuming second quarter is the quarter where you have that 50% drop off in revenue compared to that same quarter 19, then you carry on to the third quarter. And let's say third quarter, the business rebounds a little bit and they get back to at least 80% of 2019's numbers. So what that would mean is third quarter is the last quarter you would be able to claim ERTC, assuming fourth quarter is decent. So in that example, second and third quarter would be the only wages that are eligible for ERTC. first quarter's out, and fourth quarter's out. Now, the big thing for 2020 is that you got to look at the amount of full-time employees. So in 2020, it's only available to business owners that employ under 100 full-time employees, not full-time equivalents. This is different from the Affordable Care Act. So a full-time employee is defined as anybody that works at least 30 or more hours. So basically, all the part-timers get thrown out for this equation. You only look at the people that were considered full-time. And if you're above 100, then you're not qualified for this. Now, if you do have over 100 employees, you can claim ERTC, but you only get to count the wages that are paid to people that were not working during COVID-19. And I would argue, practically speaking, we haven't had too many clients that have paid people to not come to work or stay at home. So probably we're not, once you hit that 100 full-time people, I think we're going to have very few people that are going to qualify for this. And now I put a little asterisk on the very bottom. Aronson, we have a lot of what I call client groups where we have a lot of affiliated businesses that have common ownership. And if you have common ownership, what you have to do is you got to look at all the companies in that group and you got to add up all the employees. And if you're above 100, when you count up company A, company B, C, and so forth, then, you fail the eligibility for this credit. Next slide, please. So how's the credit calculated? So it is equal to the first 50% of the first $10,000 of wages that are paid to employee between March 13th and December 31st, 2020. So best case scenario for 2020, you get a $5,000 refundable tax credit on the wages you pay each employee. But the next part is very important. Any wages that are funded by a forgivable PPP loan are ineligible for the credit. So the government does not want you double dipping. They don't want you to use free money that you got from the SBA, turn around and claim a tax credit on that. So as I've been going through this exercise with clients over the last couple of months, one of the things I asked them is, step one, did you have a full or partial suspension of operations? Or did you have the revenue drop off? And assuming they check that box, then the next question I asked is, when did you get your PPP loan? And then when did you use all the PPP loan proceeds? So if you have a client that got funded in early April and they burned through all the money by, let's say, end of June, then any payroll that was paid between April and June does not count for ERTC. We can count the eligible quarters, the eligible periods and wages outside of the PPP window, but that's a very important fact. And I find that some clients, they burn through it pretty quickly. Others, they needed the full 24 weeks to, to use that up. So, and that really, factors into the credit. Now, if we have a client or a business owner where there's a full or partial suspension of operations for maybe part of the year, but not the entire year, you only get to count the wages during that period of the suspension of operations. So a lot of people, when the pandemic started back in March, they were shut down immediately, but then they were able to reopen, maybe April or May timeline. So in that case, you would only count middle of March through, reopening period. Next slide, please. And then we have ERTC version 2021. It works very similar, but there's a few differences. And actually the 21 version is a lot better than 2020. So same thing, if you're going to qualify for ERTC, you got to have either a full or partial suspension of operations, or you got to have the decline in gross revenue, but it works a little differently. For 21, you only have to demonstrate a 20% drop off in revenue. And the baseline is you got to compare first quarter 21 to first quarter 2019. And the way this one works a little bit is it's done on a quarter by quarter basis. So you do the test in first quarter 21, you hit 20% drop off or you didn't. Then you do it again in second quarter, compare Q2 21 to Q2 19, 20% drop off, you can count, the wages, same test. Now, I did have one bullet point. One option you can do to meet the 20% threshold is there's an election you can make where you can compare the gross revenue in fourth quarter 20 compared to fourth quarter 2019. So if you have that 20% drop off, you can claim ERTC in first quarter 2021. The other thing they scrubbed up in the 21 version is, basically if you had over 100 full-time employees in the 20 version, you were kicked out of it. This time they bumped it up to 500 full-time employees. So that gives you a little bit more cushion, especially for those business owners where there's a lot of affiliated companies. So again, same thing, you got to add up all the companies. So if you keep your workforce under 500 full-time employees, you're good for ERTC 21. Next slide, please. Credit calculation. So the way it works, it's equal to 70% of the first 10 grand of wages you pay to each employee, and it's in each quarter. So for right now, the ERTC 21 is available in first and second quarter of this year. So if you play your cards right, you could get a $7,000 credit for one employee in the first quarter, and you can do it again in second quarter. So that's a $14,000 credit. And that, but again, what you got to think about is you can't count the wages that were funded out of PPP. So there's a lot of people that are going for PPP round two, and they're starting to get funded. So what we're finding is the payroll in January is okay, but if you're getting funded in February and assuming that you're going to use the PPP money and turn around and start funding payroll, then you got to turn off the ERTC until you burn through all the PPP money. And the last bullet point, same way as 20, full or partial suspension of operations, you only count the wages during that period of the suspension of operations. Next slide. So how's the credit claim? That's the big question. How do we get all this money? For 2020, at this point, the only way you're going to get the money back is you have to amend the 941 quarterly returns. So if there's customers that had some ERTC in second quarter, third quarter, there might be multiple 941s that have to be amended. In 2021, you can do it one of three ways. One way is that when you go to file that first 941, let's say in April, and you know you're eligible for ERTC, you can claim it on that form directly. Also at 21, there's a couple ways where you can kind of get the money up front. If you know you're going to get this credit, you can reduce the payroll tax deposits that you give the government on a monthly basis, and then you reconcile, what you held back on your deposits versus what you're entitled to when you do the 941. The other option is you can say, hey, government, I want an advance payment on this credit. So you file a Form 7200 to get that advance payment. And the reason why you do this is a lot of times what we're finding is these credits will more than exceed the taxes on the 941s. The Social Security, the Medicare, the federal withholdings that are collected and remitted to the government. And remember, this is a refundable tax credit. So even if the credit exceeds what's been paid in or what the tax is on the 941, that's okay. You get all the money back. Next slide, please. So why is ERTC very important? And really, there's a lot of things for this. The first thing is, and this is what's driving me nuts as we're starting tax filing season 2020, is that the rule of thumb is if you're going to claim this credit, what the government says is on your 2020 business taxes, whether it's an S Corp, C Corp, or a partnership return, you've got to reduce the wage deduction. They don't want you double dipping by taking a tax deduction for those wages and then claiming a credit on those wages for ERTC. So what we're doing right now with 2020's taxes is we're trying to scrub up and figure out who's eligible for ERTC in 2020, because in all honesty, the money is worth more than the tax deduction. And let me repeat that. The money is worth more than the tax deduction. So to give you an example, if we have a customer that's eligible for a $100,000 ERTC, it's $100,000 in their pocket. But then if the government says, well, you got to reverse $100,000 of payroll on your business return. And if let's say that the business owner has a 40% blended tax rate between federal and state, so they're going to pay $40,000 more on their 2020 taxes, but you still yield $60,000 of cash, $100,000 refundable credit minus $40,000 of additional income tax that you pay. You still come out a winner. But the challenge that we're having right now is that the government was very late in making this change to this ERTC. And while it is a very good change that they made, but it's a little bit of a timing difference because we've already set expectations with a lot of clients for how the 2020 taxes are going to shape out on April 15th. And the dilemma is that this ERTC, what we're finding is it could take several months to amend these 941s. And then it could take a couple more months for the government to issue the refunds. So, it's really sitting down and having a conversation with your accountant to see, does this credit make sense? And if it does, what does this mean for my taxes? What's the timing here with, paying more taxes on April 15th versus getting the money later? So there's a little bit of a timing difference, but in the end, you're still going to come out a winner when it's all said and done. And as I mentioned, these credits could be sizable. I've seen some credits right now that are in the 5 figures. I've had some in the 6 figures. If you take a client that's got 20 employees, 10 employees, or even as you start creeping up towards 100 employees, it could add up if you get $5,000 of credit on each employee. So really something to take pretty seriously. Next slide, please. And that's really all I have. That's it. So this credit, I will say, it's very advantageous. It is complex. There's a lot of rules, a lot of details to go through. There's a lot of steps you have to follow to go through it, but really strongly take this thing into consideration. And with that, that's all I have. I'm going to open up to you guys for questions.
Okay, Dawn, can you take the slides down, please? And we will open it up to all participants. If you want to ask Aaron a question, please unmute yourself and ask.
Hey, Aaron, that's Steve.
Hey, Steve.
From a payroll perspective, right? We haven't seen the changes on the 941 yet. So in our payroll system, we have special codes that going forward, we can put employees' pay codes into that section, and the 941 in the end will be programmed. But have you seen the 941 come out with this ERC credit on there?
I have. I looked at a 941 about a month or so ago, and remember, this ERTC was out there last year. It's been around since March or April, but very few people were going for it because of PPP. It was a non-starter. And there is a specific line on the 941 where you put something in there for the employee retention tax credit. So it is on there. It is buried. I will tell you practically, it's not going to change the methodology or the mechanics of how the 941 works. You're still going to have the same payroll taxes, same wages. The only difference is when you get down to the deposits, the credits, like the family sick leave is a great example as well. It's going to work the same way. That's where the credit's going to be claimed, is when you get towards the end of the form itself.
So in terms of 2020, if somebody wants to go back into 2020, just as a side note, then we've got to revise those actual payrolls and show an overpayment in the deposits in order to be able to get that refund back.
Right, and that's quite possible. That's correct.
That's a lot of work.
It is. And I will tell you offhand, that's one of the reasons, because I've had clients that have had some pushback from an ADP or Paychex or Heartland as an example. Not to pick on them, but they are inundated with a lot of amendments. And as you said, it's not a quick fix and then you're done. So for that reason, some of them have told our clients 8 to 12 weeks potentially to get these things refunded. And that's on the conservative side, because as you said, it's a lot of work to put this stuff out. But there's a lot of money at stake.
Is there a deadline?
No deadline. Well, I will tell you, general rule of thumb is if you're going to amend a tax return to claim a refund, you have 3 years. There's a 3-year statute to claim a refund to amend the return. But practically, I will say that if you're going to claim the credit for 2020 and the government says the payroll deduction comes off, you should do it sooner rather than later, just because, or at least figure out what the credit is. I'll tell you offhand, I have a feeling we're going to have a lot of clients that are not going to have these 941s amended and or get the money back by April 15th. But what we're telling them is, let's figure out the credit now, because it's going to impact 2020's taxes, and we don't want to amend the 2020 corporate taxes. Let's figure it out now, at least. Okay.
Boy, you guys are going to be more busy. Never mind year end, but to have all this on top of what you already do. Oh my goodness. I
Yep.
thank you for all you do. And I would ask everybody for their patience. It's not only their end of the year, but now you have all the PPP and all this on top of what they do. So we love you guys. We send you good vibes.
Thank you.
That you make it through the season okay. I know there's some other accountants on here as well. So we'll just be kind to you. And I guess if there's no other questions, we can finish early. I want to thank you so much, Aaron, for presenting this, and Steve, thank you so much for always being a sponsor and asking all the good questions. And on that note, I will tell everyone to have a good day. I don't see any other questions here. If anybody does have one, please unmute yourself. Now is the time. Okay, well, this presentation has been recorded, and it will be on Rockville Chamber's website under webinar recordings. So on that note, I thank you, and everybody have a great day.
Great. Thank you, Margie, for having us.
Thank you.